$2 million. That's the number financial advisors love to throw around when they talk about retirement. Save $2 million, they say, withdraw 4% annually, live comfortably on $80,000 a year forever. Sounds reasonable until you ask a simple question that nobody wants to answer. Who actually has $2 million saved for retirement? Not who theoretically could save that much, not who should have that much based on some formula. Who actually has it right now, sitting in retirement accounts? The answer is going to make you feel a lot better about your own situation. Or it's going to terrify you about the state of retirement in America. Possibly both. According to the Employee Benefit Research Institute's analysis of Federal Reserve data, exactly 1.8% of American households have $2 million or more saved in retirement accounts. 1.8%. Out of every 100 households you pass on your street, fewer than 2 of them have crossed that magical threshold. The other 98 have less. Most have dramatically less. The median retirement savings for all American families is $87,000, not $870,000, not $8.7 million, $87,000. That's the middle point, meaning half of all families have saved less than that amount. When financial media publishes articles titled, "Why $2 million isn't enough anymore," or "The new retirement minimum is $3 million," they're writing for an audience that essentially doesn't exist. They're giving diet advice to people who can't afford groceries. Today, I'm going to show you exactly who does have $2 million saved, how they got there, what they have in common, and most importantly, whether that number even matters for your retirement. Because the data reveals something the financial industry doesn't want you to know. The $2 million retirement is a fantasy for almost everyone. Chasing it might actually be sabotaging your financial future. The statistics paint a picture most Americans would rather not see. According to Federal Reserve data, only 4.7% of Americans have at least $1 million saved in retirement-specific accounts like 401ks and IRAs. The number with $2 million drops to 1.8%. Those with $3 million or more, just 0.8%. These aren't cherry-picked statistics. This is comprehensive Federal Reserve survey data representing the actual state of retirement savings in America. The average retirement savings across all families is $333,940. That number sounds encouraging until you realize it's massively skewed by the wealthy. When Jeff Bezos walks into a room, the average net worth of everyone present becomes billions of dollars. Same principle applies here. The median tells the real story. At $87,000, half of American families have saved less than what many financial calculators suggest you need for a single year of retirement expenses. Break it down by age and the picture gets more detailed, but not much prettier. Americans in their 50s have an average retirement savings balance of approximately $1,025,000, according to Empower's 2025 dashboard data. Sounds impressive until you see the median, $453,000. Half of all 50-somethings have less than $500,000 saved, with retirement a decade or less away. Americans in their 60s show average balances around $1,190,000. The median drops to $544,000. These are people on the doorstep of retirement, and half of them have roughly a quarter of what the experts insist they need. Americans in their 70s, many already retired, show average balances around $1,200,000 with medians of $436,000. The average is propped up by a small percentage of wealthy retirees, while the typical 70-something has less than $500,000 to sustain them through their remaining years. The Federal Reserve's 2024 report on economic well-being found that only 35% of non-retired Americans feel their retirement savings are on track. That's down from 40% in 2021. The majority either know they're behind or aren't sure, which usually means they're behind. Bankrate's 2025 Retirement Savings Survey found that 58% of American workers say their retirement savings are behind where they should be. Of those, 37% describe themselves as significantly behind. 1 in 4 Americans has no retirement savings at all. This is the reality behind the glossy magazine covers and the financial planning software that assumes everyone earns 6 figures and started investing at 22. The question worth asking is who does reach the 2 million mark? Understanding their characteristics reveals whether the goal is realistic or ridiculous for everyone else. Ramsey Solutions conducted the largest study of millionaires ever undertaken, surveying over 10,000 people with net worth of $1 million or more. Their findings contradict almost everything popular culture believes about wealthy people. The top 5 careers for millionaires are engineers, accountants, teachers, managers, and attorneys. Not hedge fund traders, not tech startup founders, not professional athletes or celebrities. Teachers made the list. 79% of millionaires did not receive any inheritance at all. Among the 21% who did receive something, only 3% received an inheritance of $1 million or more. The average millionaire didn't even grow up around money. Most came from middle class or lower income backgrounds and built wealth gradually over decades. Here's the statistic that should change how you think about wealth building. Only 31% of the millionaires studied averaged $100,000 or more per year over the course of their careers. 1/3 never earned a 6-figure salary in any single working year. Read that again. 1/3 of millionaires never earned 6 figures in any given year of their working lives. The path to 7-figure wealth wasn't extraordinary income. It was ordinary income combined with extraordinary consistency. 8 out of 10 millionaires invested in their company's 401k plan. 3 out of 4 also invested outside of company plans. But crucially, not a single millionaire in the study cited single stock investing as a major factor in their financial success. Not one. When asked what did contribute to their wealth, 75% gave the same answer: regular, consistent investing over a long period of time. The timeline matters enormously. The average millionaire worked, saved, and invested for 28 years before reaching the $1 million mark. Many didn't achieve this milestone until around age 49. For those focused purely on saving and investing rather than entrepreneurship, the timeline stretched to 32 years on average. This demolishes the myth that millionaires are overnight success stories or lucky lottery winners. They're marathoners, not sprinters. Behavioral patterns among this group show remarkable consistency. 94% said they live on less than they make. Not 94% try to live below their means. 94% actually do it. Nearly 3/4 have never carried a credit card balance in their lives. They spend $200 or less each month at restaurants. 93% use coupons all or some of the time when shopping. These aren't frugality tips for show. These are the documented habits of people who actually accumulated significant wealth. Tom Corley's 5-year study of self-made millionaires found similar patterns. 49% were saver investors who saved 20% or more of their income from the first day they started working. 65% have 3 streams of income. 45% have 4 streams. 80% were over 50 when they achieved millionaire status. Wealth building was a decades-long project, not a get-rich-quick scheme. The math of reaching $2 million reveals why so few people get there. Consider someone starting at age 30 with 0 retirement savings. Assuming a 7% average annual return, they would need to invest approximately $1,500 per month to reach $2 million by their late 60s. $1,500 monthly. That's $18,000 per year in retirement contributions alone. The 2026 401k contribution limit is $23,500 for those under 50, with an additional $7,500 catch-up contribution for those 50 and older. Someone maxing out their 401k at age 30 and maintaining that contribution for 35 years at 7% returns would end up with approximately $2.4 million. Sounds achievable in theory. In practice, the median household income in the United States is around $80,000. After taxes, health insurance, housing, transportation, food, and basic necessities, finding $18,000 annually for retirement contributions ranges from difficult to impossible for most families. The math gets worse for late starters. Someone beginning at age 45 with nothing saved would need to invest approximately $4,500 per month to reach $2 million by 65. That's $54,000 annually, more than many Americans earn in total. This isn't a failure of willpower or financial literacy. It's a mathematical impossibility for most income levels starting from typical ages. The $2 million target assumes circumstances that don't apply to most people: starting early, earning enough to save aggressively, avoiding major financial setbacks, and maintaining disciplined contributions for 3 decades or more. Life intervenes. Job losses happen. Medical emergencies drain savings. Divorces divide assets. Children need support. Parents need care. The idealized savings trajectory exists on spreadsheets, but rarely in lived experience. The more important question is whether $2 million is even the right target. The financial planning industry arrived at this number through a combination of the 4% rule and assumptions about retirement spending. If you withdraw 4% of $2 million annually, you get $80,000 per year. Add Social Security, and you might have $100,000 or more in annual retirement income. But the 4% rule was developed in 1994 based on historical data that may not apply to future market conditions. Some researchers now suggest 3% is safer. Others argue the original rule was too conservative. The right withdrawal rate remains hotly debated among professionals who spend their careers studying this exact question. More fundamentally, the assumption that everyone needs $80,000 to $100,000 per year in retirement income reflects spending patterns that don't match most American lifestyles. The Bureau of Labor Statistics Consumer Expenditure Survey shows that average annual spending for households headed by someone 65 or older is approximately $57,000 to $60,000. For those 75 and older, it drops further. Location dramatically affects how far retirement savings stretch. The cost of living in Manhattan is radically different from rural Tennessee. A retiree in Des Moines might live very comfortably on $40,000 annually, while someone in San Francisco struggles on twice that amount. Healthcare remains the wild card in every retirement calculation. Fidelity's 2025 retiree healthcare cost estimate found that a 65-year-old retiring in 2025 can expect to spend an average of $172,500 on healthcare throughout retirement. For a couple, that number doubles to approximately $345,000. These figures represent more than a 4% increase from the previous year and have more than doubled since Fidelity's first estimate of $80,000 in 2002. Healthcare inflation consistently outpaces general inflation, making long-term projections unreliable. The estimate assumes enrollment in Medicare and doesn't include long-term care costs, which can run $100,000 or more annually for nursing home care. A single extended nursing home stay can devastate retirement savings, regardless of how much was accumulated. No retirement calculator adequately accounts for these uncertainties. The precision implied by statements like, "You need exactly $2.3 million, is false precision applied to fundamentally unpredictable circumstances. Social Security plays a larger role than many retirement discussions acknowledge. The average Social Security benefit for retired workers reached $2,071 monthly in early 2026, translating to approximately $24,800 annually. That's after the 2.8% cost of living adjustment applied to benefits starting in January. For a couple both receiving benefits, Social Security might provide $40,000 to $50,000 annually. This isn't luxury money, but it's a substantial foundation that exists regardless of personal savings. The maximum possible Social Security benefit in 2026 is $5,251 monthly, or approximately $63,000 annually. Reaching this maximum requires earning at or above the maximum taxable earnings limit for 35 years and delaying benefits until age 70. Only about 6% of workers earn enough to qualify. For most retirees, Social Security provides between 30 and 40% of pre-retirement income. The program was designed to replace approximately 40% of working income, and it largely succeeds at that goal for average earners. Combining median Social Security benefits with median retirement savings produces a different picture than the doom and gloom headlines suggest. A couple with $500,000 saved, withdrawing 4% annually, generates $20,000 from savings. Add $50,000 in combined Social Security benefits, and they have $70,000 in annual income. reduce housing costs by owning their home outright, which most retirees in their 70s do, and that $70,000 stretches considerably further. This isn't the lavish retirement promised by financial product advertisements, but it's also not the desperate poverty implied by articles insisting that anything less than $2 million equals catastrophic failure. The people who do reach $2 million share specific characteristics worth understanding. First, they started early and never stopped. The 28-year average timeline to millionaire status means someone who began at 25 might reach the milestone around age 53. Someone who waited until 35 might not arrive until 63. Time is the irreplaceable ingredient. Second, they automated everything. Wealthy accumulators don't rely on willpower to save consistently. They set up automatic contributions that move money to retirement accounts before they ever see it. Third, they avoided lifestyle inflation. When their income increased, their spending didn't increase proportionally. Raises and bonuses went to savings rather than upgraded cars or larger houses. Fourth, they stayed married or partnered. Research consistently shows that married couples accumulate significantly more wealth than single individuals, partly due to shared expenses and partly due to the accountability of having a partner who shares financial goals. Fifth, they got lucky. Not lucky in the lottery sense, but lucky in the sense of avoiding catastrophic events. They didn't face extended unemployment. They didn't have major uninsured medical events. They didn't go through expensive divorces. Luck doesn't determine everything, but it determines more than the self-made narrative acknowledges. Sixth, they earned enough. Despite the statistics about millionaires who never earned six figures, the math favors higher earners. Someone making $150,000 can save $30,000 annually while still living well. Someone making $50,000 cannot. The honest conversation about retirement that nobody wants to have acknowledges several uncomfortable truths. Most Americans will retire with less than the experts recommend. This is already happening. According to the Federal Reserve, 82% of retirees say they're doing okay or living comfortably financially. These are people with median savings of $200,000, not $2 million. They're making it work through combinations of Social Security, part-time work, downsized housing, and adjusted expectations. Working longer is becoming the norm, not the exception. Gallup data shows the average retirement age has risen from 57 in 1991 to 61 today. Many people now plan to work into their late 60s or early 70s, whether from financial necessity or personal preference. Geographic arbitrage matters more than most people realize. The same retirement savings that produces constant anxiety in California might fund a comfortable life in Portugal, Mexico, or even lower-cost American states. Healthcare anxiety exceeds the actual costs for many retirees. While the $172,500 Fidelity estimate sounds terrifying, it's spread over roughly 20 years of retirement. That's approximately $8,600 annually, or about $700 monthly. Substantial, but not the retirement-destroying figure the headline implies. Social Security's future is more secure than apocalyptic predictions suggest. Even under worst-case projections, where the trust fund is depleted by 2033, the program would still be able to pay approximately 75 to 80% of promised benefits from ongoing payroll taxes. Benefits might be reduced, but they won't disappear. The financial industry has incentives to maximize fear about retirement savings. More fear means more assets under management, more insurance product sales, and more advisory fees. The industry benefits when people believe they need $2 million and feel panicked about falling short. What actually matters for retirement security is different from what gets clicks. Debt elimination consistently predicts retirement satisfaction better than raw savings totals. Entering retirement without a mortgage payment, without car loans, without credit card balances, transforms how far savings stretch. Health maintenance extends working years and reduces healthcare costs simultaneously. The retiree who exercises regularly and maintains healthy weight needs dramatically less medical intervention than the retiree who doesn't. Social connections predict well-being in retirement more strongly than wealth does. Retirees with strong social networks, active community involvement, and sense of purpose consistently report higher satisfaction regardless of account balances. Flexibility in expectations allows adaptation to circumstances rather than rigid adherence to plans that may not survive contact with reality. The practical framework that emerges from this data looks quite different from conventional retirement advice. Save as much as you reasonably can, starting as early as possible. Any amount is better than nothing. The person who saved $500 monthly for 30 years ends up far ahead of the person who planned to save $2,000 monthly but never started. Maximize free money from employer matches before optimizing anything else. An employer match is an immediate 50 or 100% return that no investment can reliably replicate. Keep investment costs low. Over decades, the difference between a 0.04% expense ratio index fund and a 1.0% actively managed fund compounds into hundreds of thousands of dollars. Avoid trying to time the market or pick winning stocks. The millionaires studied didn't get wealthy through brilliant trading. They got wealthy through boring, consistent investing in broadly diversified funds. Delay Social Security if possible. Every year of delay past age 62 increases monthly benefits by approximately 8%. Someone who can afford to wait until 70 will receive 77% more monthly than if they'd claimed at 62. Plan for healthcare costs, but don't let fear paralyze you. HSAs offer triple tax advantages and can accumulate specifically for medical expenses. Medicare provides a foundation that most retirees find adequate when supplemented appropriately. Consider part-time work as a feature rather than a failure. Many retirees find that some work provides purpose, social connection, and income simultaneously. Stay flexible about location. The retirement that seems impossible in your current expensive area might be entirely achievable somewhere else. The question isn't really whether you can save $2 million. For 98% of Americans, the answer is no, not under current circumstances using conventional approaches. The question is whether you can build a life in which retirement works regardless of hitting that arbitrary benchmark. The retiree with $500,000 saved, no debt, reasonable Social Security benefits, part-time work they enjoy, strong relationships, good health, and flexibility about where they live may be happier and more secure than the stressed executive who technically has $2 million, but also has a $1 million mortgage, expensive tastes, and no identity outside their career. Numbers on a screen provide one measure of retirement readiness. They're not the only measure, and they may not be the most important one. The financial industry wants you obsessing over whether you've saved enough because your anxiety is their business model. The truth is that retirement security comes from multiple sources, not just accumulated assets. A 70-year-old woman named Helen was part of a retirement study that tracked actual outcomes rather than projected ones. She retired at 66 with $340,000 saved, far below every recommended benchmark. 10 years later, she was still doing fine. Social Security covered her basic expenses. Her modest savings provided buffer for extras. She downsized to a smaller home in a lower-cost area. She worked part-time at a garden center because she enjoyed it, not because she had to. She described herself as happy. Her situation wouldn't make a compelling financial services advertisement. There's no dramatic transformation, no massive account balance, no luxury travel lifestyle. There's just a person who figured out how to make retirement work with what she actually had rather than what some calculator said she needed. That's the reality for most Americans approaching retirement. Not $2 million, not catastrophic poverty, something in between that requires creativity, flexibility, and the wisdom to distinguish between what the industry sells and what real life demands. The 1.8% with $2 million saved have figured out something valuable, but the other 98.2% are figuring out something too. Retirement isn't a math problem with a single correct answer. It's a life transition that accommodates far more variation than the standardized advice acknowledges. You may never have $2 million. Most people won't. That fact alone doesn't determine whether your retirement will be successful or miserable. What you do with whatever you have determines that. And that's something the $2 million target never tells you.